thank you everyone so much for joining us today. The purpose of this webinar today here is to really educate and inform you all on something that's very, very important. You may have heard of the CAR or Form C annual report. Very simply, right? What is this? This is a required reporting requirement that you have as a founder if you have conducted a regulation crowdfunding offering from the general public. Once you have done a regulation crowdfunding offering or actively doing a regulation crowdfunding offering that spans from last year into this year, so on and so forth, you will need to begin providing CARs each year for 3 years, unless you meet other termination requirements around that reporting. Very simply, what is this for? This is to provide a way to keep your investors up to date, which speaks to a broader point about the importance of investor relations and keeping people informed about how your business is performing once they've actually invested in your business. It is a super important part of the overall equation when it comes to raising capital in these markets. And it's something that far too many folks do not engage in and are falling out of compliance, both with SEC standards and frankly, falling out of favor with their investors and hurting the overall market. So today is all about educating you on the importance of CARs, educating you on how we plan to let the public know about CAR noncompliance to help drive up compliance rates and get more investor relations going in this market so more people feel as though their investments are going towards progress in the businesses they're backing so that they continue to back more businesses down the road. So with that, we have a wonderful expert in the field of CARs, Greg Burke. He is a professor. He is a researcher at Loyola. He's an amazing, amazing individual. I'm so excited for you all to meet him here today. I've known him for many years. He's a wonderful researcher who utilizes our data at Kingscrowd all the time to do research, and he's done some wonderful analysis in this space. So he's going to join us here now, and we're going to get into all things CARs, the importance of them, how they work, how you can get them done, why you need to do this, so on and so forth. So thank you again for joining us, and Greg will be here in a second, and we'll get into it. Greg, thank you so much for being here today.
Yeah, happy to be here. Thanks for including me, Chris.
Absolutely. So, Greg, for those who don't know you, just give a little bit of background on yourself and what the CAR is all about.
Yeah, so brief background. Chris and I met a few years ago during my grad school days at Duke. Since then, I am now at Loyola in Chicago. I'm an accounting professor here, and my main area of research is in exempt transactions, specifically regulation crowdfunding offerings and kind of the economic accounting environment around that. So specifically in terms of what it relates to today, I have a study that looks at compliance behavior of issuers that are obligated to do these annual reports. And so we have some statistics and some information about what that looks like. And yeah, high level, to answer your second question, I guess, Chris, is the annual reporting is that obligation that follows after an issuer has sold securities, and they need to continue doing it until they reach that termination requirement. And happy to share little tidbits and statistics as you all find helpful.
So yeah, let's break it down for folks. First off, what all goes into a CAR?
Yeah, so I think the main driving body for the CAR is the financial statements. Now, there's other additional disclosures that are required, but the idea is that you're providing a balance sheet, income statement kind of information so that investors understand what's going on year to year. One can think of this, those investors that are familiar with wider public equity markets would think of a Form 10K, except much, much, much smaller and easier to complete.
And the reason why this requirement was created, why did the SEC put this in place? What was the idea behind it?
Well, I certainly can't speak for them directly,
Sure,
but in
sure.
general, the SEC is weighing between, investor thinking about investor protections. And so, of course, once an investor engages in an investment at a firm, they're going to be interested in monitoring that investment to some extent. We can think of public equity markets. People trade, right? They buy more stock, they sell the stock based on information. sometimes at least. And so the only real information in this market would be some kind of disclosure from the firm, right? Investors are outside the firm, they don't know what's going on. And so one way the SEC thinks about protecting them is providing them information, right? So as long as an investor has honest, open information, they can choose things that are good for them or bad for them, right? But as long as they have that information available to make a choice. And I think that's the main driver of having at least some disclosure in the market after an offering.
So for a founder, because I know there is some confusion here, when do they need to complete a CAR? When do they hit that requirement as needing to do it?
Yeah, again, not a lawyer,
Yep.
but it's after an issuer or once a founder has issued securities. So you closed at least one offering. At that point, your annual reporting requirement is now in place. And any fiscal year that has passed where you haven't provided financial statements yet, you have to file those in the form of an AR within 120 days of that year end. Now, the tricky thing here is once you issue securities, right? So this is, I think, the edge case that people get confused on. But high level, once you've issued a regulation crowdfunding security, from that moment forward, anytime you pass a year-end threshold, within 120 days, you got to file that Form CAR.
And how long does a reporting requirement last?
Uh, High level, indefinitely, unless something else happens, right? So if you don't do anything about it, you have that reporting requirement forever. The thing that you definitely have to do for it to end is file a form TR, right? A termination requirement. But there are a few requirements in order to meet in order to even file that. The gist of them has to do with if you're getting bigger or you're getting a lot smaller, right? So the bigger version is now you have to do more rigorous reporting. So your investors are already getting more rigorous reporting, so they don't need this. Or you're a lot smaller, you have a lot fewer issuer, or you have a lot fewer investors, you have a lot fewer assets, you went out of business, someone else, you bought back those securities, those types of things that indicate that you're smaller. If you meet those requirements, which are, of course, much more specific than I'm laying them out, then you are able to fill out a termination notice and then therefore terminate your obligation. Now, under a couple of those, there's some requirement to have like at least one, or at least I think three is the other one.
I
But
think typically it's three, and then filing a CTR is usually what people are looking for, right?
yeah. But for
Um,
example, one that would vary from that is, if you go out of business, in that case, there's no requirement to file one, right? You just need to file a TR and then you're good to go. So it kind of
yep.
varies depending on the situation.
No, that makes a lot of sense. Now, another thing that folks get confused about it is providing the financials. They're like, wait a second, like I have to provide more audited financials. That's going to cost me a ton of money. Talk to us about what level of financials need to be provided based on different circumstances.
Yeah, so financial statements need to be GAAP compliant, so they need to follow US GAAP, which is just the auditing standards established in the or not the audit, the accounting standards established in the United States for external reporting. And so they have to be GAAP compliant. For annual reporting, there is not a audit or attestation requirement if you aren't already getting one. So if you're a founder and you don't need an audit for any other reason, you don't need one for this. So you can save your money there. Uh, However, you need to have GAAP compliant financials. What that means for you as a firm, that's hard for me to answer, right? To what extent you can translate your QuickBooks or whatever accounting programming that you have internally to something that is doing accrual accounting and other GAAP compliant items is kind of a case by case basis. But I think that's kind of the biggest hurdle I'm guessing for folks. But again, I think it's really important to know that there's no requirement of an external person coming in and reviewing, monitoring, or whatever. You would only have to provide audited financials if you already have audited financials.
Well, and I'll say this, some of you folks who are on the call may be going, okay, well, where do I even go? What am I going to file? What is it going to look like? So we do have a service at Raise Papers that basically think of it as TurboTax for your CAR. And it's going to provide you with a bunch of prompts to answer questions, upload files and documents that you need in order to be able to file your CAR. And then we file it with the Edgar system. All the complexities essentially involved with the CAR, we remove all of those and make it as simple as possible so you get back to running your business rather than doing reporting. The reason why I bring that up now, and I'll drop a link in the chat for you all to be able to purchase that and access our CAR tool, is that a lot of folks get hung up on like, I don't know what the heck gap financials are or what they look like. Basically, it's certain fields, right, meet the requirements of GAAP for these standard practices, cash and cash equivalents, terms like that. We'll walk you through what those actually mean in the questionnaire that you get through the Raise Paper service. That'll help you fill that out. However, if you're still confused, but you don't want to go and hire, an accounting firm to be, an auditor reviewer level, you could go and get a bookkeeper to help you kind of go through your books and then get those key numbers out of it. But many folks do find that by the prompts that we provide and going through their financials, they could pretty much piece together the GAAP financial data they need to file with the SEC in their annual report. So it truly is not very complicated. Some people get hung up. We can provide a little bit more explanation. And then if you're still really feeling hung up, you get a bookkeeper. But you do not need to go spend 10 or 20 or $30,000 getting an audit. You could pretty much do it on your own, pulling from your books, or maybe getting a bookkeeper for 4 or 5 hours to help you really feel confident about what you're filing, because they are then self-certified. You have signed that these are true and real. So if we do find there's issues down the road, right, the SEC or whoever else, then certainly that could put you in hot water and you wouldn't want that. But ultimately, you can do this on your own if you want to. So just putting that out there.
And Chris, I'll jump in a little
please,
bit.
Please.
To speak to that, I think, what's very interesting about this market and across founders is there's high heterogeneity, a lot of variation in what these firms look like, right? I'm sure some that are listening have really early stage firms that are not revenue generating, that maybe even have barely any assets, and others that are much more sophisticated. And, the analogy for preparing your taxes, I think, is a pretty good one here in terms of preparation costs, right? So, folks that have very basic personal income stuff can do very easy TurboTax options there's like a free service. They can pretty much probably do it by hand. But as you have more complicated assets, as you have more things going on, you may need more help. And so I think that kind of speaks to your point before, right? There are, if you're in this really early stage, the burden on you is going to be much less, right? Because there's just less to keep track of. And so I think founders that feel already underwater because they're like just kicking off, well, in fact, this is probably not going to be that hard, right? Because there's less going on. You don't need to be keeping accounting records for all of these things because there's nothing really happening from an accounting perspective.
Right.
Right.
Absolutely.
So I think that it's just keeping in mind that depending on where you are in your, firm's development will depend on how much support you need.
So one of the other things, first up, if you don't file a CAR, can you raise another Reg CF without that CAR being filed?
Legally, no. Yeah. Yeah, if you don't file a CAR when you're supposed to, then you shouldn't be issuing any more securities. That's
And by the way, all the major platforms started in WeFund or Dealmaker, they're not going to let you raise until you file your CAR. And by the way, if you haven't done it in 2 or 3 years, right, you did a Reg CF, say in 2023, and now it's 2026, and you still haven't done one, and you go to do another Reg CF, now you're going to have to file 3 to make sure you cover all of the years up until now. So you can find yourself in a real hole.
In that interim time, you're exposing yourself to enforcement actions. I mean, none have happened yet, but theoretically, you are non-compliant during those 3 years.
Oh, absolutely. I mean, like we've been around the SEC with the work that we do, and certainly it's something they're looking at and talking about is the need for folks to file their CAR, and that there could be issues if you don't file your CAR. So that's certainly out there. You don't want to be out of compliance with the SEC. It's just not something you want to do. As much as I hate filing my taxes, I know I don't want to be out of compliance with the IRS. This is the exact same thing. You might get by without getting in trouble, but you might get in trouble. And like, do you really want to deal with that? and then an SEC investigation and all the costs and legalities that come with that? No, you certainly don't. Plus, if you want to go raise more money, you're stuck because you can't do a new Reg CF until you have that CAR filed. Greg, I know in your research you've seen some interesting data around kind of, issuers who do file their CAR and how much more money they're able to raise. Keeping your investors informed is not only good practice, but it also does help companies raise more money. Can you talk to some of the stats and data you've seen around that?
Yeah, so we don't have a causal claim in terms of if you're compliant, how much more you raise in the future, but we do have some descriptive information. So I can tell you two things about that. The first one is that in general, people that are compliant, they're raising in the terms of maybe 4 to 5 times as much in the future. Now, that is definitely not a causal claim, it's just totally descriptive. Um, Another thing I can tell you in terms of investor demand is that we have kind of two tests that we do looking at investors' access to Form CARs directly from Edgar. And we can see the data we have is basically every single document that every single person looks at an exact timestamp. So we know every single time someone's accessing on Edgar, and we can see two main things that happen. One is that Form CARs are being accessed around when they're due.
Hmm.
So we can see a huge bump in traffic for Form CARs at the deadlines. So, or the main deadline, which is the end of April, beginning of May. And
Yep.
so that implies that number one, people are accessing them. We like see that, but they're also accessing them when they are expecting them, right? When that information is most fresh, which means they're not just accessing them randomly, they're accessing them because they're looking at them. Um, and the other thing that we notice is they also access them as new raises start. So if you have done two Reg CF offerings, we can see what are they doing with your old CARs as you start a new one, and we can see a huge spike in accessing your old CARs the first couple of weeks after you've started a new raise. Again, the exact timing when that information matters the most, which again implies that your investors are information sensitive, and they also care about this specific type of information.
No, 100%. And, we talk with all the capital raising agencies out there. If you've done a raise in the Reg CF space or Reg A space, you probably have heard of Capital Department or Maverick Brands or Potomac Growth, um, Merrick Creative. There's all these groups that help you raise capital at scale through ads, through IR and communications. But what a lot of them tell us is the importance of building your community and not overnight, but over time. And what that entails is doing really good ongoing investor relations. I can tell you from my own experience, kind of the same way, descriptive, not, perfectly statistical, just looking at the numbers. Typically, when we do a Reg CF raise, right, we have 5,000 investors, but the bulk of dollars, probably nearly 70% of dollars, are coming from repeat investors rather than new investors. A lot of new investors will put in a small amount, $500, $1,000. But then the old investors will put in $10,000, $20,000, $50,000 because they've built trust or you've built trust in them by providing really good ongoing reporting and investor relations. I'm communicating with all of our investors at least at minimum just on updates 6 to 9 times a year. And then they're probably hearing from us about 15 to 20 times between all of the kind of email communications that we do. What I'm saying here is that staying in front of your investors matters, no matter how small the group, because there's a lot of value within that group if you do a good job of keeping them up to date. So these things do matter and they play a major role in how much money you're going to raise in the future. I can tell you that as a founder who's been through this time and time and time again. So
I think a thing to add to that too is,
please.
if during your offering, your disclosures are accurate and representative of your firm, then the expectations your investors are going to have of
Yep.
your performance will be related to reality. And
Hmm.
so, investors in this market aren't expecting you to perform, consistently every single year like a blue chip firm, right?
Hmm.
These are not those investors, right? So like there will be years that are good, there'll be years that are bad, right? And so, this fear of not reporting because maybe we have bad news, well, if you have again disclosed appropriately up front, your investors understand that, right? And so I think the biggest risk here, again, this is all mostly speculative in my
Yeah.
opinion, is that you're not keeping them updated at all, right? And
Yep.
so they have no idea what's going on. So I think, again, being upfront about this, your investors, you'll level set upfront, and then you can continue to level set, year by year by year, and no one's expecting you to 10x within, 6 months.
Another question we get a lot is, hey, I'm late. I haven't filed. Does it make sense to still file, or is it better to not file?
It's always better to file. Yeah. Yeah.
I
So
like it seems we get that question all the time. Like, well, I'm late. Should I just not file? It's like, no, 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 no.
yeah.
You need to file.
And
So
in fact, I can tell you with that one, I've spoken with SEC staff directly about that question. And the general rule of thumb is it's always better to get back into compliance than to wait. So that's like from the staff as well. And one brief caveat that's related to the legal side of this, if you are a founder of a large firm, without getting into the legal intricacies, the risk of you not reporting gets higher because there are certain thresholds which you can cross, which then puts you into a position where you would have to become a fully registered firm with the SEC. Smaller firms are protected from this to some extent, but if you're big enough and you cross these thresholds, you have an even bigger problem. So founders of larger firms should be especially careful of remaining compliant.
I couldn't agree more. Um, okay, question that came up from the crowd. If I raise with 2024 financials but close by April 30th, 2026, I don't need to file, right?
This is a common misconception. So, if that is how your understanding is, that is a commonly held belief, but it's wrong. So closing early doesn't protect you from preparing financials. It only protects you from potentially filing an AR. You would otherwise, if you stayed open past April, you would have to prepare financials, but it would be in the form of an amendment to your offering. And then you would just be able to stay open. If you close early and that 120 days from that year end has passed, then even if you close the day before the AR is due, the AR is due the next day because the moment you close that offering, you have initiated your ongoing reporting obligation. Now, for those people who have already issued securities, and then is start another one, what I just said isn't relevant. You have ARs kind of no matter what. But those that are in their first offering, if you pass the threshold, it's an amendment. If you stop before, you don't avoid reporting. You have to do the AR.
Awesome. Very helpful. Another question that came from the crowd. What if I don't do the CTR? Do I need to keep reporting ongoing?
Yes. Technically, yes. So, I mean, I would send you towards, I think it's like issuer guidance on the SEC's website. It's pretty straightforward. There's one, two, three, four, five exactly bullets under, yeah, guidance for issuers, which are pretty straightforward. So if you meet one of those, you just need to file that TR, which is very straightforward, and then you're good. You can like put this behind you, put it to bed, and not worry about it. Technically, even if you've gone out of business, right, you have an ongoing reporting obligation, which is hard to think about until you file that TR.
Yep. And again, I've dropped it in the chat, but we provide CARs, CTRs in the form of a TurboTax-like software solution. So you can get this done very quickly, easily, affordably, and move on with your life. And not have the overhang that you're no longer in compliance at the SEC and enables you to raise in the future. I believe in that guidance in terms of the CTR. They typically say you file a CAR, and I think it's like within a week you have to file a CTR if you want it to take effect. So if you filed a CTR last year and you're like, oh, well, I filed it last year, so I'll just file a CTR this year. No, you would have to file a new CAR this year and then file a CTR, and then you would be removed from the requirement.
Yeah,
Um,
there's some requirement of when you meet the criteria and then when you file the TR afterwards. Um, yeah, there
yep,
are some timing requirements. I would say those are less important than filing at all, right? I think
a hundred
and we
percent
got to
agree.
meet that threshold first. And one very brief thing that's related to
Please.
might be relevant to founders is, and I've heard this question myself, is founders that have actually acquired or taken over another company that had issued Reg CF securities. So they're kind of like inheriting this. Um, they had asked if they needed to continue reporting. And the question really comes down to is, do you technically still have investors, right?
Mm.
And if you have inherited this, even though someone else made the decision, you bought the company, so you inherited this obligation until you meet one of these criteria and file your TR. So I think even if, and I know this may be more rare, but does happen, if you've acquired another firm that has issued Reg CF securities, this is also your obligation.
Absolutely. Yep, 100%. Last question from the crowd, and then I'll kind of wrap this up. Greg, how important are financials in your opinion, as most of the companies raising are true startups?
That's a hard question for me to answer because I can't speak for all of the investors in this market and how they use that information. Uh, I would step back and say more the idea of having a consistent update across an investor's portfolio of investments so that they can compare firm to firm, year to year, I think is just helpful information for them to decide, what their portfolio will continue to look like going forward. It is fair to say that there's less information to use if your revenues are zero, right? But there are other things to be considered, right? In terms of maybe they're worried about cost controls, or maybe they're worried about exposures to different things that you might clarify in your disclosures. There's more to it than, just the top line. But this is a conversation that might even be helpful to have with your investors, and maybe a small group to be able to make sure that your disclosures are kind of meeting their needs and also consistent with GAAP, of course.
And by the way, required. So
Yeah,
it's a
yeah,
part of the requirement. So important or not, they need to be in there.
right.
Um, as we wrap this up, one of the things that I wanted to mention here is that we have heard this, louder and louder call from our own investor base at Kingscrowd. And by investor base, I mean all of our members who subscribe to the Kingscrowd website to find their next investment and to track their investments over time. They want to hear more from their founders. They want to hear from the companies they're backing. And they get very upset when they don't hear from it. And so one of the things that we're doing to assist with that is we are putting out a list that's going to show them the companies that they've invested in that have filed their CAR and be able to get all the information about what all in there was valuable to them to know, right? What are the good updates and the challenging updates, so on and so forth. And then we'll also let them know what companies have not filed it and are out of compliance with the SEC. And we'll be sharing this with the industry. And really the idea behind this is to stress to everyone how important this is to make it more public and visual so folks know what's going on in the market. And frankly, to help founders who don't even realize that they're out of compliance and help investors be able to reach out to their founder and say, this is something I need to make sure that we align all the interests of all the parties together. This is not a big deal. This is a 1 to 2 hour effort a year to provide this information to your investors. It's baseline what you should be doing. You should be providing at least a quarterly update from my perspective, but this is at least a way to get started. So if you don't want your name on that list as being out of compliance and not meeting the expectations of your investors, certainly head on over to Raise Papers to get that filled out. We've dropped the link in the chat to be able to do that. I think this has been really informative and really helpful. Greg, thank you so much for your time. Any last remarks before we end this?
I always like to say in these conversations that, seller beware, right? If you want to issue equity crowdfunding Reg CF securities, you should understand what you're doing. And one of the things that is very, 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 very clear up front, even if you read like the 3-page issuer guide on the SEC's page, is you will have to do this, an annual reporting thing. So, if you're thinking about issuing Reg CF securities, and your platform isn't telling you everything you need to know, you are still responsible. So do your due diligence, be careful, make sure your investors get the information that you promised them from the get-go.
100%. Greg, thank you so much for your time and insights. Thank you to everyone for joining and have a wonderful day.